So let us assume that you have been following this stock for a long time and decide that that you'll buy it when it breaks out of this resistance at 80 rupees. We'll not disclose the name here, and let's just concentrate on the price chart and how we would behave if we were to be presented with such a price chart. That we had a very long, since 2008 the stock is falling from 400 rupees down to 2 rupees, and then it has recovered to 60, 70, 80 rupees. This also is a major rally, and over the last 13 years we have now come to a point where this breakout seems to be an imminent breakout uh, in July 2020. So July 2020 stock goes up 65% just in that month. Breakout happens at 80. Uh, let's say the momentum strategies confirm the trend and pick it at 100 rupees, right? So uh, by this time, anybody who's was watching it at 50, 60, 70 rupees right here is thinking that it's gone up too much, although it has beaten the resistance, and but it has gone up suddenly too much, 65% in just in 1 month. So we're going to wait for this, and not run after the stock. What does the stock do? The stock moves up fiercely above that point, and within just 1 month goes to 270 rupees, 170%. And of course you bought it here basis your momentum strategy, and you are up 170% in just 1 month, and you are of course delighted. And then what happens? A small correction happens in the stock, and you basically lose 24% in a very short while. You started at 100, you went to 270, then you lose 24% to come back to near 200. So you are a bit disappointed, and mind games have started. Phase of regret has started, that I should have booked at 270, 170% gain was there. It's too late now. Uh, it is not too late now. I'm still up 100%. 100 to 200 is there. Let me book now and exit. Those kind of queries will come to your mind because you have not planned when you are going to exit. You are taking one day at a time and seeing what is happening in the market, what is happening in the stock, and then one fine day you are taking a decision basis something, and that something could be either a proper exit plan, or it could be that everything was coming down in those 3 4 months, and there was a atmosphere of fear. And if that atmosphere or environment of fear was not there, you would have not exited. But everybody around you was making you fearful. So you exited. Let's take my profit and get out of it. Who knows, whether this is going to go up or not. Now the stock goes up 10x in the next 1 year, 1.25 years. It goes from 200 rupees to 2000 rupees. This is a log scale, so you can't see that impact of the rally. But it goes 10x from there. And that momentary weakness that you had of exiting that stock basis no other reason but just fear of losing profit. You did not have a strategy that you're going to sell 20% lower, but just for whatever reason you got out of it and never got in again. Because when it started to move again, in your mind you said, I'm not buying this stock now. I just sold it at 200 rupees, now it is back again at 300. I can't be buying this. But from that point it went to nearly 2000 in 1.25 years. Now the second mind game is happening. You are now regretting that why did I ever sell this stock? I had this fantastic position at 80, 100 rupees. Yes, I got double of that money and I got out at 200, but I missed this entire rally. And I made a huge blunder. This was a beautiful company, and this is going to make me rich in the future also. So you decide to wait for an opportunity for re-entry. And by the time you decide, you are already seeing 2000 rupees on that stock, and out of FOMO, uh, you are buying in January 2022 that yes, this stock is going to 10,000, and it was a mistake to sell at 200, but now I've rectified my mistake, and now the stock is going to go extremely well. Now what happens after your re-entry? This time the stock starts to fall. It has crashed 75% from there. and you're down 75%. Now you are virtually back at where you had last time sold the stock, but this time you bought it at the top and you are right here. uh, the pivots are breaking. Your thesis about the fundamental thesis about this stock is also shaken up, because it was never about the fundamentals, it was all about the price rise, but you were justifying it basis fundamentals or whatever hearsay you had on this stock. So massive pain and regret on entering without proper rules, without proper exit plan, and just out of FOMO. And this is a story of every second or third portfolio in the markets. Now you are anchored at that price of 2000 rupees. You are saying, I'm not going to exit this stock now if does not come to my price. I will not lose capital on this stock, come what may. And you hold the stock. You hold the stock, and this is 2022. And for the next 3 years, it does not give you any opportunity of going back to the high price. So, what exactly has happened in both these cases? This is a phenomena where investors sell winners too early to lock in profits but refuse to sell losing stocks, hoping for reversal. Can you see the investor behavior at the 2 points? In the first case, the profit was bothering him, that I should not lose my profit. And in the second case, the loss is not bothering him, that I want my capital back. And in both cases, you are witnessing what is called the disposition effect. Now, how does a momentum strategy solve this? Let's say momentum strategy was riding the stock. Four strong rules of momentum: what to buy, when to buy, how much to buy, and when to sell. At all points of time, these rules have to be clear. And how do these rules help with the disposition trouble? Is that you will be able to sell your losers very early. You will have many small losers, many losers, but most of them will be small losers, because it is just like you are trying out all stocks that are showing promise. Some of them will not fulfill that promise, so you'll get out with small losses, but some will continue to rise and you will ride that winner. So there'll be few big winners, and winners are allowed to run till the momentum fades away. The untold secret here for the sustained success is that not every trade needs to have a positive outcome. This accuracy business that is there in your mind, that whatever transaction I do should result in a positive outcome, is a wrong hypothesis to start with. You can win very handsomely even if half of your trades do very well. Half of your trades do well, half of your trades go wrong, you can still do very well. That is the untold secret. Now, in the last 5 years, this is the violin plot of an absolute momentum strategy. You can see most of the trades are concentrated around plus 30% to minus 25%. And primarily, you can see in the 0 to minus 10%, maximum number of trades are there. So, lot of small losers, small losers. Some bigger winners of 20%, some bigger winners of 30%, some of 40, some of 50, some of 100%, some winners 150%, some winners 300%, some winners even 500% nearly. This is the crux of following and allowing your winners to run. The winners that were trying to escape this, you don't want to stop them. You want to let them run. The losers that are trying to go this way, you want to stop them as early as possible, because you don't want to go deep into a loss on any stock, and your portfolio should not go deep into a loss. So, this is called the casino math. In the last 5 years, average return per stock could be 25% if you're following a strategy. Even if you have seven stocks which did poorly than 25%, 112 or 48% stocks did 0 to minus 25%. So these are the smaller losses that you continuously take. Only 60 stocks did better than 25%, or sorry, 0 to 25%, which is 26%. Only 10% stocks did 25 to 50%, and then there are these small numbers 1, 2, 3, 4, 5, which did 100%, 200%, 300%, 400%, 500%. But several multi-baggers, but nothing compared to the total trades done. And despite almost 50% of your transactions going into a loss, you are registering fantastic portfolio gains. Average return per stock is still 25% over 5-year period. This is a example from a momentum strategy, for instance, just to show you how momentum strategy works by choosing to stay with the winners and losing small in every loser. So think of it like this: you don't cling to a toxic partner, assume that's a stock, losing stock, because you've spent time on them, and because you don't ghost a great partner, a winning stock, just because things are doing well. So when things are going well, don't be fearful, embrace that. That is your vehicle for success. Anything that goes well for you, do not give it up. And anything that is not doing well for you, which is a losing proposition, which is a basically sapping you of energy, finance, or whatever it may be, that is something that you want to give up very, very quickly. So stick with strength and cut the dead weight, right? Absolutely. So that is sort of the message that should go out, and you should be embracing your winners. And of course, please let us know if you agree or disagree with this disposition effect thesis, and how you deal with losers in your portfolio is something that I would like to read in the comments. Thank you so much, and do share these videos with your friends and family. Thanks. Bye.